Hi, I'm Kara Murphy, and this is Money with Murphy. If I had told you in January that investors would face war in the Middle East, higher oil prices, sticky inflation, and fewer expected Fed rate cuts, would you have predicted the S&P 500 would still gain more than 10%? Yet that's exactly what happened. Today, let's look at three developments that shaped the first half: renewed enthusiasm around artificial intelligence, broader participation across markets, and higher interest rates. First, let's start with AI. Investors are no longer focusing solely on AI's potential. AI-related spending is increasingly translating into measurable business results. Revenue growth has remained strong across the AI ecosystem, from semiconductor manufacturers and cloud infrastructure providers to businesses actually building the infrastructure that powers AI. Spending on that AI-related infrastructure by just four major technology companies is expected to reach $725 billion just this year. What's important isn't just the size of that spending, but where that spending is going. Utilities, for example, have benefited from expectations that data centers will drive significantly greater electricity demand in the years ahead. But AI is no longer just a technology story. It's increasingly an infrastructure, energy, and capital spending story. There is a downside, though, to that incredible rate of growth, namely market concentration. As of June 30th, nearly half of the S&P 500's market capitalization was represented by just two sectors: information technology and communication services. Interestingly, performance between those two diverged. Information technology gained 20% year to date, while communication services returned less than 1%. The story wasn't just that AI remained important, but that investors shifted from believing in AI's potential to evaluating its actual results. Corporate earnings have been a consistent bright spot. First quarter earnings for the S&P 500 companies grew by nearly 30% relative to the prior year, the strongest pace since the fourth quarter of 2021, and more than double what analysts had expected at the start of the year. And that growth wasn't limited to just a handful of technology companies. Small capitalization stocks also staged an impressive comeback. After spending years in the shadows, the S&P Small Cap 600 was up roughly 24% year to date through June 30th, easily outpacing the S&P 500, thanks to improving earnings and attractive valuations. The earnings plus valuation picture has also helped international stocks. In particular, emerging markets have been among this year's strongest performers. There too, leadership has changed dramatically. A decade ago, China largely defined the story. Today, South Korea and Taiwan have become much larger drivers of performance because of their role in the semiconductor supply chain. The takeaway is simple: market leadership changes. Some of the strongest opportunities this year have emerged outside the areas attracting the most headlines. Diversification helps investors participate when that leadership shifts. Now, while stocks captured the headlines, bonds told a different story. Bonds faced a more challenging backdrop, though returns remained positive. The broad Bloomberg U.S. Aggregate Index gained a modest 0.6% year-to-date through June 30th. Inflation during that time remained stubbornly elevated, thanks in part to higher oil prices. In fact, markets shifted from expecting interest rate cuts by the Federal Reserve at the beginning of the year to potential rate hikes, particularly if inflation fails to improve. Kevin Warsh's transition into the Fed chair role in May added another layer of policy uncertainty. Higher rates drove bond prices lower and yields higher. While that created short-term challenges for bond investors, there is a silver lining. Higher starting yields provide a stronger foundation for future returns. Despite those pressures, the U.S. economy has remained remarkably resilient. AI-related capital investment and productivity growth have been strong. Unemployment remains near historic lows at 4.3%. And consumer spending, which accounts for roughly 2/3 of gross domestic product, has held up. However, the consumer story has become more uneven. Higher income households continue to spend on travel and discretionary categories, while lower income consumers are pulling back on things like dining out and purchasing appliances. Inflation, geopolitical developments, and the ongoing AI build-out remain important areas for investors to watch. Tensions between the U.S. and Iran eased during the second quarter, but re-escalated more recently, highlighting how quickly geopolitical risks can change. AI remains a major focus for investors, with additional high-profile AI-related IPOs expected later this year. History shows, however, that IPO performance can vary widely. The first half of 2026 reinforced a lesson investors have learned many times before. Market leadership rarely stays the same for long. The names making headlines today may not be the same ones driving returns tomorrow. That's why diversification remains so important. It helps investors stay prepared for what comes next instead of trying to predict it. As always, invest wisely and live richly.